I'm Brian Dorr. Thank you for coming today. Thank you, Justin. I just going to tell you a little bit about myself. I got into the real estate business in mid-90s, early 90s, 93. It was a time not unlike today. So I graduated in 93 in Canada. Anyone who was around then realizes that was a really tough time to find a job. Graduated from McMaster in undergrad in economics, and I went to Laurier to take a degree in accounting. After about 50 job rejections, I ended up with 2 job offers. The number one job offer I got was from Litton Systems. And I show up to the interview, and maybe not appreciate that Litton Systems makes cruise missiles. So that's their big thing. So I show up to this office in Mississauga. It's got barbed wire, guards, protesters, the whole deal. So I get in there, I do the interview. They're quite stressed out. And after I get out, I'm like, okay, this is not great, but okay. And they make me an offer, which is amazing. Fortunately, I had another interview, and that was at Canada Mortgage and Housing Corporation. And at that time, what did I really know about real estate? I knew my mom was a realtor, so I kind of had a clue. I knew they owned a house, but when I got there, I was greeted by actually someone who's now one of our board members. He was dressed in a t-shirt and shorts and a Birkenstocks, and he says, yeah, we got a problem. We've got all these affordable housing projects, and they're all going bankrupt. We need a financial whiz to kind of come in and just work all these projects out. So I went, this seems like a better alternative. So that's how I actually got into real estate. Had a choice of becoming a defense contractor or work in real estate. So I
think you made a pretty good choice.
I think I did the right choice. And you'll note in my career, I've always worked in housing, always been in the residential space. I've always worked somewhat with affordable housing. And when I left CMHC, I actually left. I was actually the regional controller, and I went to work for a company called MCAP. And when an MCAP, at that time, I was working as a full broker, had to do every type of real estate. So I have familiarity with every type, construction to office towers to low-rise housing. My claim to fame is I actually did Maple Leaf Square. So I was working for MCAP, was also owned by the Case. I actually financed Maple Leaf Square, same one here in Toronto. So that was my biggest deal ever in my career. Didn't make a lot of money personally, but it was a really nice deal for the resume. So I was there until shortly before 2008, and I decided to go work for a private lender. But my timing was perfect because that's when we had the financial crisis. so we have the financial crisis, everything is going down the tubes. I'm talking, it was about 6 months complete freeze. I actually think it wasn't that bad in hindsight, but it did cause the premise of my current business. So what happened was the lenders now went from lending up to 80%, like a bank would have given you 80% on something. Now it pushed them down to 60, 65%. So it opened up the private lending market. So that's why there's so many of us private lenders out here now, because back in 2008, everything got ratcheted back. What we found is we did, I left there for a bit. I went back to, the government called me again. I worked for Infrastructure Ontario, set up their lending program. So I had all this experience, developing credit, and lending. And at some point I finally said, you know what, I see a need. I'm going to go set up Dorr Capital. Our premise was we were going to look at low-rise developments. We were going to fund a little gap. And we still do this, where we would put start with a land loan, and then as we get construction, we put a mezzanine loan. That's a very good model. Unfortunately, right now that model doesn't work, so we're not really doing much in that space. But what was happening, as COVID came in, we were starting to notice that housing is gotten very unaffordable. So, and that we could better diversify risk. So that's when we started looking at these small multi-products. I also launched RealAlt to capitalize on that. And that was, so I could put Main Street, or Bay Street to Main Street, because traditionally I'm selling to large institutions.
That's right.
Speaking of large institutions, they're heavy into alternatives, just so you know. They're 40% of their portfolios go into alternatives. and a large portion of that is real estate. So what we're doing is not what is being already done by the big institutions. And that's who I traditionally sold to in my career. So what we're offering you is the same type of, I have the same type of underwriting, I do it the same way I did for those guys. Because I noticed that some of you haven't invested in mortgage funds, we offer what's called, and this is just a little bit of general education, so we actually offer real security, meaning if you have a mortgage attached to, which is our investment instrument, attached to a piece of property, we actually are the first charge on an actual piece of dirt, okay, or a building. So unlike a stock where, you know, you're investing in a company that could go up to zero or down, there's always generally a value to the property. So, and 75% of our portfolio is in first mortgages, so there's no reason to ever go to zero. There's real property there. We can just wait it out. The other thing we offer in our fund is monthly cash flow and high risk-adjusted yields. And the reason why we have high risk-adjusted yields is because it's in real estate. Real estate is not as liquid as, let's say, stocks or bonds, and you get a liquidity premium. We have our own strategies how we earn a little bit more than most, but that's in general true. And lastly, diversification. We also have another product that we offer, which is syndicated mortgage. I can actually sell you a piece of one mortgage if you like. The problem I have with that, and I invest in these, is that if something goes wrong with that one mortgage, you're stuck with that risk. You know, if you pick the right one, that's great, but if you didn't, then you got a problem. What's great here is we're diversified over a multiple number of mortgages, and that, you know, if there's anything going wrong with one, then we don't have trouble with the others. So it's well balanced that way. Our premise, as I said before, was you know, Bay Street to Main Street. So when I first started our Dorr Capital, we were literally taking large institutional transactions and breaking them up and trying to sell them to retail investors. Now we're evolving even further. So, and part of the reason why we're here to talk about is the small multis. Maybe click it up. Oh, actually, we're going to give a quick sales speech. Okay, so that's our distributions for the last year. You can see the 11.7. There we go. This past year, and I think this is just indicative of the market for the year, we've had about a 17% return.
Been a phenomenal year.
Yeah, but it is indicative of the market is very low on liquidity, and we're able to. So what we're talking about here is the missing middle. Earlier today, I was actually at a conference, and it's called the Missing Middle. I think it was sponsored mainly by the city. But a unique opportunity that I've never seen in my 33 years of real estate is I see a municipality, the province, and the federal government, and I'm saying this because I've worked for the federal government and the province, the top two layers, actually come together and with an idea that was generated by Main Street, essentially, but by people that want something different than a high-rise and realize we need to have some sort of better density and housing that people would actually like to live in. You know, we hear there's a housing shortage, except for right now it appears that, you know, houses aren't selling. The housing shortage is actually in the missing middle. There's no houses, and we're hearing rents are going down, which is true because if you're, you know, we've got about, 500 units at 400 square feet. I don't know, or I think we have 5,000 units at 400 square feet. That's just a lot of competition for, a 400 square foot unit. Not to mention the fact that those aren't really that might be fine for one point in your life, but it's not good for, a neighborhood. It's not good for a transitional. So this missing middle, units that are up to 6 units can be legally, as of right, built on any residential property in Toronto. So your single family house that you're sitting on right now in Toronto can be turned into a sixplex. Not only that, you won't have HST, and the city has waived development charges. The build cost of lower-oriented housing is about half the cost of a high-rise. Then you couple that with the fact that you don't have DCs and HST, and you're building a rental. You're at a huge advantage building one of these. So essentially what you're doing is bringing to market, let's say your market rent is $3,500, and that's what you're getting for your 400 square foot condo. these multiplex guys can afford to put out a $3,500 rent in a 3-bedroom unit with laundry, with air conditioning, with all the amenities at 1,100 square feet. You have 2 or 3 bedrooms. This is coming online, and it can be done now. And we've, I'd like to keep going. We can show you more. We talk about the incentives and the housing shortage, the development opportunities. So just to re-emphasize, government incentives are no DCs, no HST, and you're getting, the city did one other thing, which I just heard this morning from Olivia Chow. They have decided to, they've created a person who's a head that just heads up small multis. So they'll navigate you through all the different departments when you're getting your units approved. So RealAlt and Dorr Capital, we want to back the builders that are putting this up, okay, and the developers that are putting this up. Because the other thing that's key is speed. Speed, speed, speed. So speed of capital is important. Getting institutional capital. All right, so one of the key features that we have here is they're as-of-right zoning, DCs that I just talked about. There's also build forms that are very flexible because you've got these garden suites, okay, so that's pretty cool. The other thing is, if you build 5 or more units and they're rental, you can get CMHC MLI Select insurance, which means you can have up to a 50-year amortization and a 1.1 debt cover. I'll say that out loud. What that means is you could probably own a $3 million property for about $500,000 cash. That's your down payment, and you're making money, okay? So to me, I've never seen anything like it. This is pretty amazing, and I've done all kinds of things in real estate, and I've decided to go, I'm going downscale because this is what we need, and I've always worked in housing, and it's always been something near and dear to my heart, and it looks like it's going to be profitable, and we're still providing affordable housing. Like when I say value-oriented, this isn't social housing. This is just housing that people can afford.